Everybody, this is Michael Martin. Today I want to do part 2 of capturing downward pressure in the S&P 500, and I'm going to call this one How to Protect Your Equity in Otherwise Uncertain Markets. Now, yes, the sharp pencil crowd out there can say that all markets are uncertain, and I will concede that. I think given today's environment, we just want to consider where we are in the overall marketplace and what you're going to do to protect your equity and hopefully keep the gains that you've already got on the books, perhaps as unrealized gains, and not give it back. So let me get the mouse going here. So the first thing I want you to think about is contrarian thought. I know Jim Rogers has mentioned this quite a bit. Adam Taggart of Business Insider had an interesting article earlier the week, and there's a lot here. When you go against the grain, you can be ostracized because you might be the only person in the space who's trying to be cautious yet optimistic. You've probably heard the adage, the nail that stands up gets hammered down, and that could be the case, especially with Twitter, social media. It might be easy to get psyched out, and it might be easy to set yourself up for some ridicule. But, keep in mind the person who kind of offset their portfolio the Wednesday, Thursday, or Friday before Black Monday in 1987. They probably got head slapped, but at the end, they had a whole lot more equity in their account come that Monday, Tuesday, just by being in cash. And so when you think along the lines of a contrarian, it also makes you emotionally responsible for your own actions. And what do I mean by that? Well, it's very popular to have gurus come on TV and start spouting at the mouth about what their opinions are about the market. Now, Shiller comes out and says that there's a market bubble. This was also early in December. And what would a bull market be without Siegel coming out and saying that even at historic 5-year highs and 52-week highs, the market is still undervalued. So I think Jeremy Siegel is out of line here. I'm going to disagree with him and open myself up to some conjecture and some head smacking, but I'm going to show you why I think you'd be better off thinking along the lines of the way I think right now than the way Professor Siegel thinks himself. I will also concede that when it comes to speaking about fundamentals of stocks, that Professor Siegel could talk me under the table. But the point is that I'm going to be very, very aggressive in protecting my capital, and I'm going to use technical analysis to know how to get out of trades, not to look for particular setups. I want to know where the market's going to capitulate. Of course, you have the wirehouse Deutsche Bank buy and hold nonsense saying, we're going to see a flood of pent-up capital hitting the market, and I do agree with that. For those of you who are in the financial planning space or know about retirement plans, the sponsored savings plans known as 401ks, a lot of the high net worth executives or the highly compensated executives, they get capped out once they've committed their annual maximum. And that can happen depending on how much they make and how much they decide to forsake in cash flow from their period over period paychecks. They can be capped out as early as March, April, May of the year, and then the whole rest of the year they can't really contribute because they've already put in their max. So January, because they do it on a calendar year, will reset the clock. So there will be a flood of pent-up cash hitting the market. But that's like fanning the flames of the fire. So let's take a look. We also have Henry the Wiser. He's a very smart person. As they say, a crash of 7,000 Dow points starts with a single down day. And that can be true if it's not an outlier event where you have some act of God or some bad news hit the tape. It can just be the beginning of weakness. We'll have to see which one it is. Just to put things into perspective, we're looking at the SPY here. This is the daily chart from my previous video. Here's the 5-year high. Chart looks beautiful. You have to be long here. But we also have margin debt. Now, this was just released, so this takes you through October of this year, and it shows you where margin debt is as it relates to the market. So you have to say, well, what's propelling the marketplace? Now, here we're talking about type 2 margin, which is what's lent to clients against the value of their securities. Now, typically, these folks aren't buying and then coming up with new cash. They're using leverage. They're using credit to buy securities that they otherwise cannot own outright, and they basically look to sell those as a profit. So when the market gets hit, they need to cut their leverage quickly because, as you know, the sword cuts both ways, and you can give back a lot more money than you wanted to, unless, of course, you were somehow hedged. I don't suspect these folks are buying like married puts, but who knows? So this is a danger sign, just to be very, very clear. You're looking at the red line, and keep that in mind as we go through the next few slides, because what you're going to see is pretty outstanding. Again, this is a slide from the last lecture, and it showed you what happened after the margin debt had hit highs and what happened to the marketplace afterwards. You want to focus your eyes here at these peaks, and even though these look small on the screen, think of them in percentage terms here. I don't know about you, but they look like 30 to 40% whackings, thrashings, as far as I can see. And that's history speaking here. That's not me making it up. This is why I think Siegel is a little bit, if you're 25 years old and you have $10,000 in an S&P 500 fund, most of your income earning years are before you, so just leave well enough alone. But for the rest of us who want to protect our capital, or at least want to sidestep the drawdown, you can take a look at this wonderful chart that I think came courtesy of JP Morgan and was published at Business Insider. And it shows you where the S&P was in terms of those are the bars, the dark green, forest green bars, of what was the year-over-year, calendar year returns for the market. But what I want to point out are the lavender purplish dots, and that shows you what the worst-case drawdown was in actuality over the course of those years. In other words, the down years were actually much worse, and I've taken the liberty of kind of highlighting a few of them where, if you remember, we talked about the emotional constitution of market participants in the previous lecture, of where they feel euphoric and where they feel despondent. You know, the one in 2008, they were down 38%, but you were down 49, almost 50% at the low. Again, and this is when margin debt was high. Look at these years. It's 2000 to 02 and then 08. Oh my gosh, look at these big years. High margin debt, margin debt's got to cover. They got to liquidate. Same thing here, coming out of 07, high margin debt, and look what happened in the marketplace. Market got hammered, margin debt went down. Why? Well, because people are using borrowed money. So that's a system unto itself, folks, and that's already happened twice in the last decade. Well, a little more than the last decade if you go back to 2000. And that's in recent history. If you're my age, you obviously lived through that. And I'm not saying become a blatant short seller, but you know that this is history repeating itself. So you have to be very, very careful. The question would be is where could you take even your S&P 500 fund at Vanguard, keep it fully invested, and just learn how to sidestep the drawdowns, and then learn to get back in at a 1 to a 6 month high. What would the effect be even after paying taxes on your capital gains? That's a little bit of a homework. Here's a chart from Bloomberg that I kind of cropped to illustrate more of what the margin debt looks like when it's decreasing. Again, it decreases because people are selling stock to cover their margin balances. They're not adding cash. So I don't know which is going to come first, either chicken or the egg. Will it be the pension and the 401k funds coming back to the marketplace? Or will it be anything based on, Jeremy Siegel's arguments? But I do know that sooner or later this money is going to get paid off, regardless of how cheap it is. And so what you want to do is put yourself in a spot so that you're not affected by amateurs. Why would you want amateurs to be basically emotionally wagging the tail of the marketplace? Why should you have your equity be impacted by an amateur's sense of despondency because they don't know what they're doing and they've been reckless because margin balances come at very low interest rates? Where in my career, I've seen them at over 9%. I've seen margin interest rates between 8 and 9% over the course of the year. probably 20 years ago. So you want to find yourself is how can you put yourself in a spot of not necessarily euphoria, but in a site of optimism along all of the points on this curve. And that's by being in control and also realizing that you are in control of yourself all the time. And what you can count on is when people get spooked, they are going to hit the sell button indiscriminately to pay off their margin balances. Now, I'm not here to preach, but I am here to help you protect your capital, because at the end of the day, no one's going to count or care for your money more than you. And when you start to be responsible for your own actions, you will find yourself not on any of these places on the curve, because euphoria is great, but don't fall in love with your own headlines, right? You still have to protect your capital. And you can avoid despondency and depression by taking actions and going all the way back. Let's see if we can go all the way back. And the wisdom of looking like an idiot today. You can't worry about Schiller. You can't worry about Siegel. You cannot worry about Deutsche Bank. And you should listen to Henry and say it all starts with one single downtick, and that's it. So here you are, protect your capital. Don't get stuck into the fear and try to hang on for dear life, because once it starts to go, I'm sure all these people said, oh, it's going to come back. The market's going to come back. But they don't realize that the margin debt and the repaying and the offsetting, right, is what's really going to be driving the selling. And when you see that coming, you have to get out of the way. So ultimately, you are the only person you can count on, and you have to be responsible. The only way that you can do that is to think differently. You need to have a plan ahead of time. You need to know where your uncle point is. You want to be able to sidestep the downdraft and protect your capital. You can absolutely read all the fundamentals that you want, but you should absolutely use technicals to sidestep the bloodbath and see where the selling's going to hit. Now, in the lessons that I'm going to teach my students, we're going to talk about the different vehicles and how to do that, and also where to position, if you're a long-only investor, where to position yourself on the chart and where to say uncle so that you can protect your capital. And then we're going to look at historical charts to see on where a good re-entry would be. If you like these videos, please subscribe to the YouTube channel, and you'll see them as soon as they're posted. Or if you would prefer to have them personally delivered to your inbox, you can subscribe to the one and only Martin Chronicles exclusive email distribution list, and we'll give you some updates that way.